Get some insight now on the probable interest rate hike in the US. Viv Govender from Lehumo Capital joins me now. Viv, thanks for coming in.
Sorry, me.
All right, let's start perhaps with that concern by the World Bank. Now, it's not something new. We've been hearing about these concerns for some time now. But given the timing of when they've released this warning and the fact that the economy of the world has changed somewhat in the past few months, is it significant?
Yes, it is. I mean, if you look at let's look at the BRICS countries. You know, Russia is obviously experiencing quite a big downturn because of the falling oil price. They're very dependent on the oil price. Brazil has had these problems, you know, for the last little while, partly due to commodity prices, partly self-inflicted due to a massive overspending. China's in trouble. South Africa, of course, you know, our growth rate isn't great. Even among other developing countries, places like Nigeria, Angola, where oil prices and other falling commodity prices have put a huge amount of pressure on those economies. For the US to start raising rates right now, though it may be the correct thing for the US to do, it would be because negative for these other economies. Of course, the Fed doesn't really have any mandate to look at other economies. It looks after the US primarily. Yeah.
Capital flight. I mean, just how serious is the possibility from emerging markets and a country like South Africa?
It's significant. I mean, if you look at just how much we depend on foreign capital to basically maintain our trade accounts, etc. Because remember, we are spending much more on other people's goods than they are spending on ours. So we need money flowing from other areas to basically make up for that spending on goods. And not just South Africa, but we're looking at like Brazil. Brazil, the real has weakened dramatically. Russia, we've seen come under pressure. The Chinese have weakened their currency purposefully, but they weakened their currency because they were, to a certain extent, pegged to the dollar, and the dollar was strengthening so much that they had to basically rebalance themselves to be fairer with the other parts of the world. So it really has a huge impact. The US dollar is or the US interest rate is effectively it's kind of like the repo rate for the world. Yeah. Everybody works off that particular rate. If they raise, everybody else is going to be under pressure to raise as well. Yeah,
interesting. It comes at a time when we just heard some good news on our current account deficit, the deficit narrowing. Is this now another threat?
Oh yeah, most certainly. I mean, if we see the US raising rates and we don't follow along with that, we are likely to see basically people that don't want to buy our bonds as well, because they say there's a good return or a slightly better return in the US bonds. They become more attractive versus our bonds, and that's going to mean that we don't have the reserves coming through or the foreign inflows coming through to actually support the deficits that we do likely occur.
All right, now, when we look at the possibility of a rate hike, majority says it can't happen now. There's a minority that says it possibly can. But if it does, 0.25%, that's not going to make a heck of a lot difference. So I would imagine what's important is what Janet Yellen actually says in that speech.
Yeah, and the strange thing about that probability is that if you look at different markets, like, you know, like for the 2-year versus the 10-year versus corporate bonds, are pricing things slightly differently. So there is a lot of confusion about this. No one knows for certain, you know, what they're looking at. Yes, it could, in terms of just how this is going to be affecting us, it's not that one-off increase that's going to be important. 0.25% is not enough to change the world. But the Fed basically, if it comes out and says it's going to be doing one movement now, then waiting for more data to basically do another movement and really calm the market, saying, yes, we did a movement showing that we're turning around, but we aren't going to be looking to rush and get back to normality anytime soon. That will be much more coming to the market. If, however, the Fed indicates that they're quite optimistic about the US economy, that they believe things are okay and need to return to normality, then we would see much more of a reaction, because that would mean that they're going to be raising at a faster pace.
As far as emerging economies are concerned, I guess the scenario really magnifies the importance of China at the moment. I mean, if China goes or continues to go the way it is perceivably going, that's not good news at this time, is it?
Yeah, well, so if China works, if the perfect scenario for China, which is that the government manages to control the economy like they want to, the government is changing that economy from being an infrastructure, export-based economy into a consumer-based economy. Understand what that means? Export-based, infrastructure-based, a lot more raw materials are used. Consumer-based, lots more services are used, lot less raw materials are used. China accounts for about half the world's demand for copper, for iron ore, for pork, for a huge number of commodities. It means that if China basically switches over to a consumer-based economy, even if they grow at the same rate that they're growing right now, it would really have an impact on the world. But if they switch to a consumer-based economy and they're not growing as fast as they used to in the past, it's going to be very, very negative for virtually all of Africa, much of South America, even places like Kazakhstan, Mongolia, Russia, even Australia as well. Countries that were basically built their economy over the last decade and a half, supporting the demand for commodities from China.
I guess it's pretty obvious. The next question, domestically, South Africa, as an emerging country, will have to do what it takes to remedy the situation internally.
We've got to find some other source of demand. One of the issues, one of the problems with the debacle with the visa things is that we've had a case where a weaker currency should be attracting visitors, because we are a cheap, great tourist destination. Come to South Africa, see the animals, and now you can do it for half the price you could have a few years ago in dollar terms. Unfortunately, because of the visa regulations and some other, basically shooting ourselves in the foot with regards to certain things, we have diminished other sources of potential revenue for the country. We need to find some other sources. We can't be dependent on commodities for this foreign inflows into our country, for our trade, towards exports. We need to basically look to more value add from, for instance, manufactured goods, from tourism, from other services, which we can do, but we just have not been able to fully exploit that at the moment.
Viv Govender, thanks very much indeed for your time.
Thanks for having me.